Hi, my name is Kristen Torres, and if you're watching this video, that means you've either met with me or you were given access to my QR code so that you could have insight as to what is a life insurance retirement plan. I have an office just outside of Nashville, Tennessee, and I've been in this industry for almost 8 years. I have a previous career in healthcare where for about 5 years I was a registered respiratory therapist and then went on to get my bachelor's of science in nursing to become a registered nurse. And I still hold that license today, although I only work in medical missionary trips and not in a clinical setting anymore. So let's get into it. And if you would like to jot down my address, that is the address to my office. Although I work outside of Nashville, Tennessee, I can pretty much help or service anyone in all 50 states. And if you ever need assistance or need to contact me, you can definitely reach me either by my email address, which I will definitely leave to you in the comment section of this video. Also, I will leave a link for you to schedule a consultation if you do not have that link already. So let's dive into it. And I'm going to kind of just lightly skim over some things regarding other insurances because sometimes they can get a little mixed up between what index universal life is and how we use that in a LIRP setting for a life insurance retirement plan versus other insurances that you might have heard of and been familiar with, but might not be able to tell the difference between all of the different insurances so you can truly understand what a life insurance retirement plan is and how insurance ties into that. So again, like I said, we'll look at the different types of insurances, but basically we're going to be focusing the conversation on cash value because that's how these life insurance retirement plans work and some things to consider and be aware of. And also, like I said, determining if alert using an index universal life plan is appropriate for your portfolio and your financial goals. So, as I said, we'll touch lightly on term insurance, which basically term insurance is there for you to cover your liabilities while you're building your assets. Pretty simple, pretty straightforward. Term insurance is usually the least expensive type of life insurance because it does have a term and it does expire. So, for instance, I have an example here. Someone acquires a term policy at 30 years old. They got a lot of liabilities. If you think about it, when you first finished school, or if this is you right now, and you're thinking, yes, I have a car note, I just bought a house, I have a mortgage, I have all this debt, student loan debt. Well, then you understand that your liabilities are great, but over time, you're going to be paying those liabilities off and your assets are going to grow. So during that time, what a term life insurance policy does is it pretty much serves as that safety net. Just in case you pass away while you still have a lot of liabilities, it's going to cover those liabilities because you never got to the point where you could actually build your assets to be able to pass that down to the next generation. You can get term life insurance in different time periods, 10 years, 15, 20, 25, 30, right? I've even seen some companies maybe go beyond that, or you can renew that. But as I said before, just make sure you understand the actual objective of term life insurance and know this is not used in plans such as life insurance retirement plans. You do also want to make sure that you acquire living benefits if possible with a term policy because only about 2 to 3% of term policies actually pay out for death. The rest are actually going to serve you for different critical, chronic, and terminal illnesses. Those are things like cancer, heart attack, stroke, paralysis, right? Those are some of the more common ones that we see when we file claims against term policies. Most people have just a regular term policy that does not have living benefits. So if you can get with a company or a broker who might be able to kind of look at different companies to see which ones offer living benefits, I would highly suggest that because that can keep you from going financially insolvent if you were to ever run into a medical condition and you still need to pay your bills, but you don't have any income coming in because you can't work. And this is an example of a living benefits check of one of the claims that we did, and it paid out almost, I would say, 600,000, a little over $600,000 to this client, and he had about $750,000 in term life insurance. Next is whole life insurance. Now, I will say that people get this confused when we talk about other life insurances that have cash value. But one thing about whole life insurance that you do want to take note of is it is one of the older models of cash value life insurance. So a lot of things about whole life insurance is going to have some of the older model details. I like to compare it to a flip phone, like what we had back in the day, to a smartphone that we have now. Back in the day, we could not get on the internet on our flip phone. We still could make calls, text, things like that. But now we have smartphones that do almost everything. So the same goes for using something like whole life insurance versus all the other cash value life insurances that were created afterwards for something like a life insurance retirement plan. So typically you'll see whole life structured in a way where, hey, you're going to pay for a certain amount of time or pay to 100 years old until that whole life policy calls what we call matures. So that means that you're no longer paying into that. And the only thing that changes while you're putting money into this whole life policy is how much access to cash value you have. Okay. So that's why you're not going to typically see this type of plan used for life insurance retirement plans, because when you take out, there's no leverage and you can only access what is available to you. So even if the policy is matured, what you're taking away is essentially probably not going to grow or multiply into more for you to continue to keep taking it, especially at the interest rates that whole life cash value grows. All right, so let's get into it. The index universal life plans. And so these are the plans you're going to see typically used in a life insurance retirement plan. So remember, we use that term LIRP, L-I-R-P. So life insurance retirement plan. And these policies actually mimic permanent life insurance because they run on what we call annual renewable term. Now, we won't get into any specifics because there are ways where you can kind of scale back on how much life insurance that you actually are paying for in these plans. And of course, if your goal is to live off of the cash value and the interest that is accrued in the cash value every year, you do want to keep those life insurance costs down. So, again, there's ways, and I'll kind of skim over that just a little bit. But if you want to get into more detail about that, we can sit down on a consultation and talk more. Now, essentially, this is what you're going to see when we're talking about using index universal life insurance for cash value building or accumulating purposes. And again, this is how we're going to use that term LIRP in reference to the cash value that we're accumulating in this index universal life plan. So as you can see at the bottom, it says face amount. So that would be the amount of insurance that you're going to purchase, and the broker should be able to let you know how much insurance needs to be purchased to allow you to put whatever sum of money you want to put into your cash value. So, for instance, we have that red line and it's not changing because that is how much life insurance that person is purchasing. And of course, they're not using that as the cash value, right? The cash value is a different component, and the cash value is growing with that policy or on top of that policy. Okay. And so what that looks like is if you pass away, whatever cash value you grew plus your face amount is what's going to go to your beneficiaries. So your family, whoever you want to pass that money down to, there's actually both of those. So whatever cash value that you did not use or spend in retirement, plus the amount of insurance you were purchasing or paying for at that time, they're going to add those two together, and that's what goes to your family. I have heard people say, well, no, I heard that you get either or. Well, that is actually explaining whole life. So that is why you would not want to use whole life in this type of life insurance retirement plan strategy, because this one is going to make sure the two are separated. Okay. Now, on the other side, it looks a little different, and you see that the line kind of decreases. Well, that's going back to what I was referring to when I said if you want to start purchasing less and less insurance as time goes on, so that more money is involved in the cash value component and less money is actually going towards insurance, you can actually do that. That is a thing. There's a certain terminology that we use in the broker world. A lot of times you'll hear us say optimal switch. But basically, what we're doing is you're starting out paying for a certain amount of life insurance and you're scaling back and decreasing that amount of life insurance that you're paying for so that more money is going to the cash value, more interest because you have more cash value, and of course, more money you get to use while you're alive. Either or, however you want to do this, however you want to structure it, the cash value is the main component. And so that is the part that you are going to be living off of as far as interest is concerned. And we'll go into how you draw that money out without incurring any type of taxes or taxable event. So this is a breakdown of how those premiums are used. Sometimes you might even hear someone say, "Oh, I heard my neighbor is paying $500 a month for, $250,000 of life insurance. That seems high." Well, if your neighbor is paying it into something like an index universal life plan, please understand that all $500 of that premium is not going to the insurance. So this is usually how it's broken down. Let's say that you are purchasing a $250,000 index universal life insurance plan and you have $500 a month to contribute to it. And let's say that the actual cost of insurance is $100. So how this premium is going to be divided up is $100 of that 500 is going to go towards the cost of insurance. I like to think of it as getting into a nice club, right? A nightclub. And they say, hey, you have to pay to actually get in, to have fun, and to experience everything that's happening in this nightclub. So you pay the $100 charge. The rest of that money you get to go spend in the nightclub. So same as index universal life insurance, you're paying that $100 to pay for the insurance. The remainder goes to that cash value account as far as growth, some of the fees that are involved in that and whatnot, but all the rest of the money is going to the cash value account. Now, a lot of people say, well, why would I just not take this $500 and put it somewhere else instead of having to pay for life insurance and then the rest going to cash value? Well, there's a lot of benefits to index universal life cash value. And so to be able to access that cash value account, you do have to have life insurance. Now, there's some IRCs that I'll briefly skim over a little bit later that allow you to grow the money that you're growing in your cash value account tax free, as well as take it out tax free. So growing it tax free and then also taking the money out tax free. So you can only imagine that, with taxes going up in the future and everything else, if you have an account that allows you to take money out tax free, that's a gem, right? And so you're thinking of other accounts like Roth IRAs. There's not too many, but Roth IRA is one of them. But also, too, some people say, well, I know that there are some risk in a Roth IRA. I'm putting my money in the market, whatever's going on at that time, I'm subject to that if I don't know how to move my money around at the right time, as well as, some other restrictions dealing with your age. So if you're someone who wants to retire a lot sooner than a lot of the government restricted ages, typically 59 and a half years old, well, then you're also going to have to kind of maneuver around with that as well. This type of account, you have freedom to when you use this money, how you use this money. There's no age restrictions. As long as it's there for you to access, you can access it. And like I said, you can grow it tax free as well as take it out tax free. And I would say that this is a private plan, meaning if anything were to ever happen where the government mandates or changes laws to anything, this is going to be grandfathered in a way where you will never have to pay taxes on it ever again. Now, I love also the fact that this is flexible. So if you start out putting $500 a month into your index universal life plan for your life insurance retirement plan, and you say, oh, I've had a little bit of a rough month or two and I can only do 300. Well, the good thing is still 100 of that 300 will go to your insurance to keep the policy active. And then the remainder will still go into your cash value account. So it is very flexible as long as you're covering that minimum amount. You can always move about the cabin and it gives you a range. Now, why are Americans even having to supplement retirement? Why are we even talking about life insurance retirement plans? Well, for one, pensions are almost extinct. So if you think about retirement, what it used to look like, the old model, you had pensions, you had Social Security, and you had whatever you grew. And you put all that together, and all those different streams made up your retirement income. Well, pensions are pretty much almost extinct. I believe it's less than 18% of Americans even get a pension, and most of those are partial pensions, not even full. The market is not predictable. Even as of right now, as I'm speaking, the market is going up and down. And what if you get within a year of retirement and the market is in one of those periods where it's not looking too great? So you want to consider that as well. Taxes are increasing and cutting into income. Social Security is in danger of insolvency and cost of living and inflation. So those are some things as to why Americans are even having to supplement retirement. And so that's why we are having this conversation dealing with life insurance retirement plans and some other things that you might want to add into your portfolio to make sure that you can retire. Now we're going to skip this video, but essentially that video goes into pensions and how a lot of Americans thought they were going to have a pension, but ended up not having one, or they thought they were going to have a full pension and ended up only having, say, a partial pension. So that video, I believe that gentleman was in his late 70s to early 80s, somewhere in there. And, he was working with a company. They told him, hey, if you work for us for 30, 40 years, you'll get a pension. And the company ended up going bankrupt. So essentially they lost most of that pension and he was still working. That was him in his uniform at Walmart as a greeter working to kind of fill in the gap and make ends meet. So why are people using cash value as a supplemental stream for retirement income? Well, as I just said, pensions are almost extinct, and all we have left right now is the market and what it can offer us in 401ks, 403bs, IRAs, and then also to people used to really rely on Social Security. Yes, it's still going right now, but Social Security is actually on its way out the door, or at least the trust fund will be depleted by the year 2034. So for a lot of individuals who are, let's say, younger generation X, or millennials or even Gen Zs, right? They're thinking, hey, this is a resource that we're not going to be able to rely on or use for retirement income. So we have to start kind of making up our own parts to this so that we can ensure we will retire. And so this is an example of an actual client I have. And he was in his 50s when he came to me and he said, listen, I know I'm late to the party. I didn't even realize that Social Security was not going to have my back. I thought I was going to have a pension with a company and I'm no longer with them. I need to make up for lost time. And so we started putting a lot of his contributions, a lot of the money that he was putting aside to save for retirement into a life insurance retirement plan to help him with future taxes. But also, too, he didn't have a limit as to how much he could put into this plan, as far as other limits as well. And matter of fact, he couldn't even put into a Roth IRA because of income limits. And so he went ahead and reached for something like this. He maximized what he could do at his job in a Roth 401k, again, to help with taxes. But this we were able to set up for him without any restrictions as to how much after tax dollars he could put into this plan. So that's another great benefit to the life insurance retirement plan. You can design it in a way where you can put even up to six figures a year. I have some clients that put six figures a year of after tax dollars into this plan, and they're not cut off by a certain cap or how much they can or cannot put into that. Okay, so these grow very safely. They grow what we call indexed, which means you're going to get the growth of the market, but not the loss of the market. Okay, they're not taxed on growth. They can be taxed or cannot be taxed later when you use it. So again, you're growing money tax free and you're taking it out tax free. It does not count as income when you're filing your taxes when you start to use this income in retirement. Life insurance retirement plans have no 59 and a half rule, very flexible payments, like I showed you earlier, and it's not tied to their place of employment. It's a private plan owned by you. Okay. It cannot be garnished and it's protected from bankruptcy. Does not count against government assistance. You're protected from divorce in a lot or most states. And also, you're protected from something called spin down, which is if you want some government assistance in retirement or when you're older, you typically have to spend down your assets to a certain amount so that you can get certain programs like Medicaid to help you out. And I don't know about you, but if you even looked at long-term care facilities or nursing homes, how much those go for per year in cost, I've even seen an average of around $95,000 a year. So if you can offset that cost if ever needed, um, and make sure that your actual retirement money is not touched by that, but you can still get government assistance through programs like Medicaid, why not? So this is going to be protected from that. Other cash value life insurances like variable life insurance and universal life insurance also carry, like I said, that component of cash value. They're a little more volatile or a little less predictable. So we like to use index universal life cash value as a way to provide income through life insurance retirement plans. Now, this is a kind of a side by side so you can see how all these plans grow, the difference. And you heard me mention index just a minute ago, so you're going to actually get to see how this works. But in a fixed account situation, you're going to get a fixed interest rate and you're not going to get anything less or anything more. You're typically going to see an return of rate of return of 1 to 4%. Which means that if you want to know how long it takes for your money to double, all you have to do is take the number 72 and divide it by that rate of return that you're getting, and that's going to tell you how many years it takes for your money to actually double. So, of course, if you're getting 1%, your money's going to double every 72 years. If you're getting 4%, your money's going to double every 18 years. Okay. And so you're barely keeping up with inflation when we're talking about fixed accounts. So it's generally not going to get you where you want to go for retirement income. You will see this in whole life cash value. So normally when we're talking about the different ways that cash value grows, this is what you're going to typically see. Whole life cash value grows this way. Next, we have variable. So that's anything tied to the market, okay? Stocks, mutual funds. So you're thinking, okay, I understand when the market goes up, you're making money. Market goes down, you're losing money. And we all understand that. But let's talk about actual versus average return because this is very, very, very important. Now, let's say that you have $1,000 at this peak in the market. Market goes down 50%, you're left with $500, correct? Correct. Now, let's say the market goes back up 50%. Where are you there? Most people will say, well, Christian, I'm back at 1,000 because the market went down 50%, then it went up 50%. So that's a net 0%. And I would agree with you, but that's actually explaining average return. Actual return says, listen, when the market went up 50%, you were at $500. So you're only going to get a 50% gain off of that $500, which is 250. That means you're at 750, even though the market fully recovered. Okay, so you're going to typically see this in variable universal life cash value. Next, indexed universal life. So in this type of cash value, you're actually going to get to mirror market gain. So you're not directly in the market, but the company who has your money that is growing it says, hey, listen, we're going to assume the risk. Just bring your money to our portfolio. The more, the merrier. So the more money you bring to us, the more we can make, and we'll cut you a deal. We will make sure that we assume the risk. So you're only going to get the gains of the market. When the market grows, we'll give you that. But when it goes down, we're going to lock you in and make sure you don't lose a penny. So you're not losing the principal that you brought over here or that you put into this account, and you're not losing any of the gains that you earned over here in this account. So you're going to continue to do that over and over again and keep what you put in and what you grew. So over time, you're going to see a lot of that growth almost somewhat outpace a lot of the other accounts you might have because it never goes down, but it grows pretty well higher than what a fixed account would. So again, that would be your index universal life cash value. Now, let's kind of look side by side comparison with the two because I find that these two are pretty popular. Now, many IUL companies do offer a way for you to not have caps on this strategy. So there are some that do, and there are some that don't. You want to get with a broker that is contracted with a lot of different companies, and they can, kind of move around and tell you which ones do, which ones don't. But right here, as you can see, I've compared the 401k IRA mutual fund situation specifically tied to the S&P 500 strategy. And we started at 1997 as far as the actual gains and actual losses each year with this strategy, okay? Next to that, I have Index Universal Life strategy or cash value account. And it's sitting right next to the S&P 500 account. And both of them started at $100,000. So remember, one is going to go up and down with the market. One is only going to go up with the market. And when the market goes down, it's just going to lock in and stay where it was. So as you can see, we started out in 1997. Both accounts started out with $100,000. So there you go, 31%, 26%. But boom, we hit the 2001 and 02 bubble, right? Man, everybody remembers that. Or if you were old enough to remember that, you remember, yeah, it was a little rough. So 3 years of, we got to get through this. Now on the S&P 500 side, that's directly in the market, you're going to see this loss. You see it goes down to 173, 155, 118. But on the IUL side, because they're using an index strategy, you see that it just says 0%. Well, what that means is, again, they locked in, they did not lose that 198,360, and they just kept it right there for 3 years, and they waited for the market to recover. Now, the other side waited for the market to recover as well. And it did. It went from 118,000 to 150,000 off of a 26.38% rate of return. But as you can see, the IUL side using the index strategy did the same thing. Okay. So now they're at 250,000 because they never, ever, ever lost a dime during those 3 years when the market was down. So at the end here, you can see what we end up with. Now, right above that, you see it says $484,506.85. But on this side, they still have to pay taxes because this was a traditional 401k or IRA. So after taxes, this person ends up with $339,154.79. Now remember, they started out with 100,000, but they went through all the ups and downs of the market. And by 2022, not bad. You went from 100,000 to $339,000 after taxes. Now, if the index universal side, because they never ever lost anything because they were using an index strategy, They're at almost 1.8 million. And as you can see, there are no taxes because they use after tax dollars to put into this cash value account to grow. So over time, they grew money without being taxed, and now they're able to use this money without being taxed. So that is why you see no taxes or no tax bill on this amount versus the next one. Now, I don't know about you, but I can definitely see the difference. One says 340,000, one says almost 1.8 million. Which one would you choose? That's a no-brainer. So that's how those two work when you compare them side by side. Now, IRC wise, or as I was speaking of earlier, the Internal Revenue Code, or what we call tax codes, the three that you really want to keep in mind are Internal Revenue Code 101G. So when I was talking about the term policies and how you can essentially file a claim for any critical, chronic, or terminal illnesses, right? Very common illnesses, cancer, heart attack, stroke, paralysis, you name it. You can file a claim against your term policy if it has this IRC attached to it, okay? And you can get a check. That check you do not have to pay back into your term policy, and whatever is left from that term policy, you can still keep that part of your term policy going and pay your premiums. It's still there, but now you get to take that chunk out and use it for whatever you need it for. IRC 72E, as I said, allows you to grow money tax-free without being taxed, and then IRC 7702 Section A allows you to take that money out without being taxed. And that's when I showed you on the cash value component of that index universal life plan where those IRCs come into play. You can also get those living benefits, the critically, chronically, and terminally ill riders, where you get to take from the policy amount. You can put those onto an index universal life plan as well, not just your term policy. Okay. Now, this kind of goes into loans and how you're going to withdraw the money. And we're not going to get too deep into this because this is really more for my clients that are ready to start drawing out. I work with a lot of real estate investors who like to use index universal life plans for investing so they can do self lending and not have to worry about getting their funds from a bank. They can get it from themselves. But also, too, if you have children, say you have a child that is going to start driving soon and you want to buy a car, but you don't want to actually have to sit at the financing table, pay someone else interest to buy this car, you can essentially do that with your index universal life cash value account as well. So this is an example when I'm teaching those people who are using these cash value accounts very often and very frequently for loans and for self-lending, what the difference is between actually removing the money from your cash value or keeping it and leveraging it and then charging yourself interest and paying yourself interest back. But those loans don't necessarily have to be paid off right away. That's the great part. I've done about 5 loans amongst all my cash value accounts. And I can definitely tell you it's very, very easy to do. And I would say that it's better than going to a bank and paying someone else interest back. And honestly, those loans are still outstanding because I don't have to pay them back right now. When I pass away, whatever loans I did not pay or whatever balance I have will come out of my death benefit, which is my life insurance plus my cash value. So there you go. That's how that works. Now, just keep in mind, this is some of those things I want to tell you or let you know of, and some caveats, right? Because when you're putting money into these plans, it's not like what you think a bank is. You put $100 into a bank account, you can remove all $100 from that bank account. With these type of plans, they're going to allow you to remove money, but just not at the rate at which you're used to in a bank account situation. So, for example, it's what they call their surrender period, where they give you access to a certain amount of what you have in your cash value, but then by a certain time, you have access to all of it. And each company is different as far as how long their surrender period is. So, as you can see, this column is the actual cash value amount column. This column is what you have access to and what you can pull out that certain or given year. So for instance, the first year in this particular illustration, the client has almost 6,000 in their cash value account, but they can only access about 2,000 and some change after that first year, right? So we're holding back a good $4,000 almost to make sure that the policy still is going to run, still active. I've even had it to where clients started paying into their policy and maybe by month 6, they lose their job and they're thinking, okay, I do have savings and everything, but I just want to focus on getting another job and replacing my income. So can I maybe take a break a month or two? Well, the way it's structured is yes. So we made sure that you had more than enough money in your cash value account to actually pay your life insurance premiums so that, while you're looking for a job for those 2 months, you're not going to lose your policy. So then after a while, as you can see, they're going to start matching up. This is year 6 where you now see there's about 43,500 and they have access to about 41,000. And then by year 11, boom, they have access to all the money that is in their cash value account. Okay, some other things to keep in mind are there are some fees just like you would see in a bank account. I know my checking account, my bank charges me $8 or something like that a month. But if you look at the actual fee schedule on an IUL, a lot of times what they'll do is they'll front load those fees. And if you look at the fees over time, so over the time of how much you plan on paying into that IUL, they usually typically are somewhere under 1% of the total cost of that IUL. So you might see them kind of pushed up in the front in the beginning. And as the policy matures or gets older, you'll see a lot of those fees drop off. And they're usually not very high, they're very minimal. Also, you want to make sure that you understand that low market performance can, kind of impede what you want to grow in your cash value account. So, as I showed you in that example where we had 3 years where the market was negative, and a lot of people say, oh, well, that IUL never grew for 3 years. Yes, but it also didn't lose money like the account next to it did because that account was directly in the market. Okay, so keep in mind that there will be years where an IUL might not just blow the growth out of the water, but it also will not lose you money, and that's the whole point. Also, I want to talk about what it means to have a properly structured index universal life cash value account for life insurance retirement plans. Again, I won't get too tedious into this because these are client specific, meaning each policy is going to look different. Each policy is going to have different amounts for different people based on how much life insurance you have, based on your age, based on your gender, based on your health rating. There's so many things that factor into what your max line is going to be, what your target line is going to be, and what your actual cost of insurance is going to be. But this is just an example. Let's say we have a client, their max line for their policy to put into their cash value account is $8,000 or $18,000 a year, which is $1,500 a month. Or I'm sorry, $1,500 a month, excuse me. But we have something called their target contribution, meaning the Index Universal Life software is going to say, hey, this person has a max contribution limit based on everything you put in of $18,000 a year after tax dollars, which is $1,500 a month. But if they only put in $650 a month, which is about $7,800 a year of after tax dollars, they still should be okay. This still should run great. It still should grow. It still should last. The policy will not lapse if they stick to this target contribution. They're not going to get everything the policy can give them because they're not maxing it out, but this is the safe line, okay? Now, you don't want to fund it only at the cost of insurance. Remember, you have your small bucket and then your bigger bucket. If you're only putting money in that small bucket, which is the cost of insurance, are you growing money in your IUL? No, you're not. And you're using it for a life insurance retirement plan, and that is the whole purpose. So only funding the IUL at the cost of insurance line is not going to give you the results you were looking for when you came over here to use it for a life insurance retirement plan. So you want to be at least at that target contribution line. And if you cannot fill it to that line, then that means that the IUL is too big and that you need to make it smaller. Okay. So again, that would not do at $250 a month, but that would definitely do at $1,100. And again, if you need to make it smaller to fit what you can actually do and to match your goals, definitely do that. Also, I do want you to know, or kind of fill you in on this, or excuse the pun, but it says backfill. What that means is, let's say your first year you can do $18,000 a year of after-tax dollars, but you only do 10,000. And let's say you do that for the first 3 years. But then year 4, you say, you know what, I'm ready to do $18,000 a year. Well, those 3 years that you did not do 18,000 and you only did 10,000, you can make up for lost time. So in year 4, you might have a cap of 18, but you can go back and fill the first year, which you left 8,000 on the table, and then another 8,000 and then another 8,000. So that's $24,000 that you can make up for and then still fill it up to $18,000 in year 4. So I love that feature on Index Universal Life Plans. It's not like once the year's over, it's gone and you can't fill that line up. You can definitely go back and backfill that line so that you can maximize your cash value amount. Here's some really great books to kind of help you with, reading on your own about index universal life plans. Understand that banks and corporations and companies use these, right? This is where they put their money actually. A lot of banks, especially, put their money with life insurance. So you, the consumer, are able to do this on a more customized level just for yourself personally. The same strategies that the banks and companies use, you can use that for yourself for a life insurance retirement plan. So I really love Money Wealth Life Insurance. You can look that book up on Amazon and snatch it up. Or The Retirement Miracle. I know they only printed a certain amount of these books. I was able to acquire, I think, 9 or 10 of them over the years, but they only printed, I think, about, yeah, 500,000 copies. But this book is really, really great with explaining index universal life plans and how people use them for life insurance retirement plans. If you have any other questions, I would love to meet with you to, like I said, sit down and customize a plan specifically for you. Otherwise, I hope you learned a lot. And if you're looking for a non-captive broker, again, I'm contracted with over 70 different companies. So even though I am based out of Nashville, Tennessee, I can definitely help you if you live in one of the 50 states, as well as Puerto Rico and Canada.